Hello, CA warriors. How are you all doing? Friends, today we are going to start with a very interesting topic. But, friends, before that, remember the goal of this video is not to go deep into every single concept, but to give you a crisp, exam oriented summary so that you know what is important and how to remember it smartly. This book and video together will act as your perfect self study partner. And I'm super confident, guys, that after this revision, you will be able to solve any MCQ that come your way in the exam. So let's begin this rapid fire revision session. And yes, if you find these notes helpful, don't forget to share them with your friends. Friends, let me start with a question, and to every economist must answer. Question is, how do we know whether an economy is actually growing? Is it counted by salaries? Is it by looking at the company's profit? Is it by checking government revenue? Answer is no. We need to complete accounting system, and that system is called national income accounting. So national income is not just a money, it is the economic report card of a country. Hence, in this chapter 6, we are starting with unit 1, national income accounting. Now, very interesting chapter. In this topic, you'll be able to understand what are the formulas to calculate national income, not any individual's income, it is the entire country's income. If I talk from India's point of view, it is India's income. Oh, so first we should understand what is national income accounting. So, friends, national income accounting is a macroeconomic framework. Actually, it's a macroeconomic theory used to measure total production, total income generation, total expenditure of an economy during one accounting year. One accounting year, in India, we follow a financial year. It gives a complete organized picture of economic activity. Now the question arises why it exists without national income accounting, because without national income accounting, economic growth cannot be measured, countries cannot be compared, government policies cannot be evaluated. So it is essential for planning, policy making, and development analysis. So now the question arises, who have developed this concept, who have given a national income accounting concept to the world? Guys, this system actually was developed by Nobel Prize winner Simon Kuznets and Richard Stone. This shows that national income accounting is a scientifically established theory and it is not a guesswork. Oh, so now the question arises, who compiles the national income in India? Friends, in India, national income is calculated by Central Statistical Organization. Now, national income account, who is now under NSO. It complies national income accounts, GDP, GNP, and other aggregates. Now, not only national income, but before national income is nothing but it's a sum of all the states' incomes. So before national income, state incomes are getting counted. And at state level, directorates of economics and statistics is responsible. They compile state domestic products and other state level aggregates. But now again the question remains same. What do you mean by national income? Friends, actually you can understand any country does not earn. India is just a place and a piece of on a earth. Am I correct? The name is given India. No country never earns, but the country's people earns. Hence, the concept is national income is actually an income earned by permanent residents of the country, irrespective whether they have earned from India or whether they have earned from outside India. Means national income includes income earned by permanent residents. I can say from India's point of view, it's an income earned by 140 crores population in India during a year, irrespective whether they have earned from India or whether they have earned from foreign outside India. Okay. Now, but now the question arises, how to calculate national income? Now, how to calculate a national income, country's income, that is 140 crores population's income. So friends, the concept is, first you should understand how this population earns. When I say it is an income of 140 crores population, how you will going to count it? So guys, this population is actually called factors. Means population actually, you, me, we all have only four sources of income. That is land, labor, capital, entrepreneur. Now, from land we pay the rent, from labor we get salaries and wages, from capital we get interest, and from salary we actually, and from business we actually earn profits. So that's why national income is also called net national product at factor cost. It has various income names also. National income is also called national product. National income is also called national income. National income is also called national dividend. National income is also called national output. But the most technical language and the actual definition is net national product at factor cost. Now, the abbreviation is NNPFC. NNPFC. Factors means it's a India's permanent resident or country's permanent residents. Okay, so the formula is, now from below to up. This is a three levels formula for better understanding. Now, first level is, before calculating national income, we have to calculate domestic income. So first you have to find GDP at factor cost. Gross domestic product at factor cost. You will going to get GDP at factor cost from GDP at market price minus indirect tax plus subsidies. Minus indirect tax plus subsidies. Now, if I take the net effect, it is called NIT, net indirect tax. So I can even express it in this way, GDP at market price minus indirect tax. Okay, out of GDP at factor cost, I got my GDP at factor cost. GDP at, when out of GDP at factor cost, I reduce depreciation, I get NDP at factor cost. Net domestic product at factor cost. And when I add NFIA to NDP at factor cost, I get NNP at factor cost. That is net national product at factor cost. So what do you mean by NDP at factor cost? NDP at factor cost means it's a domestic income. That's why it's called domestic product. And NFIA indicates foreign income. So domestic income and foreign income, when you add, it's called national income, and the actual name is NNP at factor cost. Okay, now NFIA full form is net factor income from abroad. So this is the formula to calculate national income. Again, I'm repeating. First, you need to find out NDP at factor cost. Formula is GDPFC minus depreciation. GDPFC is total domestic product at factor cost. Depreciation means wear and tear of capital asset. Now, the question arises, why depreciation is subtracted from GDP? Friends, because depreciation is not a real income. It is used only to replace worn out capital. So subtracting is, it gives net income. Then next we come formula number two, NNP at factor cost. NNP at factor cost is nothing but it's a NDP at factor cost plus NFIA. When NFIA is, why NFIA is added now? Because friends, national income belongs to permanent residents, not just domestic territory. So this converts domestic income into a national income. Now formula is how to calculate GDP at factor cost. Friends, GDP at factor cost, I'll be getting GDP at market price minus indirect tax plus subsidies. Right? The logic behind this adjustment is market price includes indirect tax. So indirect tax should be removed and subsidies reduced from market prices. Factor cost reflects actual payment to the factors of production. That is actual real income of the population. So here I have written all the abbreviations of the formula. Am I correct? Now, after understanding this formula, some small details about the formula we should understand. First is, let us talk about NFIA. What is NFIA? Friends, net factor income from abroad. That is receipt minus payments. What do you mean by this? This means NFIA is actually a difference between aggregate amount that country citizen have earned, country citizen and companies earn abroad. The aggregate amount that foreign citizen and overseas companies earn in the country. See, basically the NFIA is a difference between income earned by Indian residents abroad and income earned by foreign residents in India. So formula is actually income earned by domestic factors employed in the rest of the world minus income earned by foreign factors employed in domestic territory. I can say it is receipt minus payments. So I can also say NFIA can be positive, can be negative, can be zero. NFIA can be positive when receipt is more than payments. NFI is negative when payments are more than receipts. And NFIA can be zero when receipt is equal to payment. So here I can say NFIA is actually a difference between national income and domestic income. NNP at factor cost and NDP at factor cost. So if NFIA is positive, that means NNP at factor cost is more than NDP at factor cost. If NFIA is negative, that means NNP at factor cost is less than NDP at factor cost. And if NFIA is zero, NNP at factor cost is equal to NDP at factor cost. Okay, so now the next concept is what is GDP? Friends, gross domestic product means income earned within the domestic territory. It means market value of all goods and services produced within the domestic territory of a country. Means national boundaries. So GDP is a market value of all finished goods and services produced within the domestic territory of a country during a given time period. So domestic refers to actually geographic confines of a country. Right now domestic income is talking about its concern about territory, whether within the territory income is earned by Indian citizens or foreign citizens, it doesn't matter. So it is geometric confines irrespective whether the production is done by Indian residents or foreign residents. Means I can say that if a Chinese citizen work in India, and her production is a part of India's GDP. But if Indian citizen owns a factory in Germany, because Germany means even though it's an Indian citizen now, but he's earning outside the domestic territory, it cannot be a part of India's GDP, right? Yes. So gross national product, GNP, GNP and GDP. The difference between GNP and GDP is just a NFIA. So if you add NFIA to GDP, you get GNP. Okay, so basically the major difference between GDP and GNP is what? GDP is income earned within the domestic territory within India, whether this income is earned by Indian or foreigners. But GNP is concerned only and only income earned by Indians. Means actually GDP focus not focusing on Indian citizen or foreign citizen, it is focusing on domestic territory. But GNP is actually focusing on Indian citizen irrespective whether he's earning from India or from the entire world. So the national includes world as well as India, but income earned only and only by Indians. So this is the basic difference. So understand over here the difference. It is a GDP, it is a total income earned by Indian citizen as well as foreign citizen, but in domestic territory. Its focus is on domestic territory, irrespective whether it's earned by Indian citizen or foreign citizen. But GNP is talking about only by Indian citizens. It is not talking about territory. Okay, so it includes production done by foreign residents and foreign company within the India. Yes, but GNP excludes such transactions because it is earned by foreigners. It excludes production done by Indian companies or Indian residents outside India, but it includes such transactions. So this is the basic difference between GDP and GNP. So after understanding the basic concepts how to calculate national income, let's understand the methods of calculating national income. Yes. Now There are basically three methods to calculate national income, which has been derived from circular flow of income. Circular flow of income refers to the continuous circulation of production, income generation, and expenditure in different sectors of the economy. Friends, now from this circular flow, three methods has been derived. Production phase, contribution from production unit. Now, from this we have derived production method of calculating national income. But from production, we derive income. So from income method is a very direct method to calculate national income, as you have to calculate income only. But there are two indirect methods, production method and disposition method. That is expenditure method, because income is always equal to expenditure. Now, so these are the three methods to calculate national income, and government can use any of the method, any of the one method to calculate national income. Now, the advantageous part is that use any method, the amount of national income which will be derived will be always same, because each and every sector has been derived from each other. So let us understand the first and very important method, that is production method. Production method is also called value-added method. In this method, whatever goods and services, final goods and services has been produced, whether in a primary sector, secondary sector, or tertiary sector, the final goods and services, their money value will be get added. But sir, now the question arises, just by adding the money value of all final goods and services, how come 140 crores people's incomes can be derived? Because guys, now people always earn income either by producing and selling goods or by producing and selling services. There is no other source of earning income. Now, either you are selling goods or you are selling services, and the money value of goods and services is always equal to income, and that is called factors income. That's why the name of the national income is also NNP at factor cost, net national product at factor cost. Okay, so by production method, just a final value, final output market value has been added from all the sectors. So what is the formula? The formula is, first we need to find out GDP at market price. See, directly, indirectly, we're going to reach to this formula only. This formula. So this formula is actually main formula. Now we are, if you're going to analyze it, if you're going to realize, this is the first stage, this is the second stage. First we find GDP at factor cost. From GDP at factor cost, we find out NDP at factor cost, and from NDP at factor cost, we find out national income. Am I correct? Now, but the base of all this entire formula, this formula starts from GDP at market price. GDP at market price, we're going to derive from production method. Okay, and once you got GDP at market price, you can go from first stage to second and third. So production method and expenditure method. First stage, from production method and expenditure method, we're going to derive GDP at market price. Okay, but from income method, we will going to get directly a second stage, that is NDP at factor cost. That I'm going to explain you, but first you understand. Okay, and then from NDP, you have to just add NFIA, you're going to get NNP. So guys, actually you are learning different points, but ultimately this entire chapter, this entire topic is just a single formula. Just this theory is extended because we are understanding each and every aspect of the each and every formula. Okay, so first we find out GDP at market price. It is also called GVA, gross value added at market price. So how we're going to calculate value of final goods we're going to consider, and we will going to reduce it the value of raw material, that is intermediate consumption, because we are just considering value addition, because once raw material is others finished goods. So to avoid a double taxation, always from finished goods value we will going to reduce now a value of raw material. Okay, that is intermediate consumption. Now, which can be raw material, I can say raw material can be purchased from India as well as can be imported. Okay, one more formula is that to find out GVA, or I can say GDP at market price, sales plus change in stock. Change in stock means closing stock minus opening stock. Don't do opening minus closing. Always go by closing minus opening. Now sales plus closing stock, change in stock minus intermediate consumption. Okay, this will going to give you GVA at now. After getting gross value added, the purpose is not to calculate GDP. The purpose is to calculate national income. Then stage two, we can find now national income. So NNP at factor cost, the formula is same as what we have studied over here. From GDP, we're going to find GDP at factor cost. Then from GDP at factor cost, we're going to reduce depreciation. We're going to get NDP at factor cost and then add NFIA. So this is how the formula is created. So sir, here it's a one line formula. Actually, it's a one line formula to make you understand three layers has been made. So GDP at market price minus net indirect tax. Net indirect tax means minus indirect tax now and plus subsidies. Minus depreciation plus NFI. You're going to get NNP at factor cost. So this is how production method will be used to calculate national income. But some points you have to keep in mind while using production method. Now, following items are included in the national income. Now, some transactions will be included. Value of output by primary, secondary, and tertiary. Value of output means final goods, that is already mentioned in the formula. Own account production by primary, secondary, and tertiary sector should be added. Now, own account production means production made for self-consumption. Production made for self-consumption. Now, and imputed rent, that rent which could be earned, it's an opportunity cost, and closing stock should be added. So following items should always be added to the included in the formula. Now, and note 2 is just for MCQ's purpose. From production method, first you're going to get GDP at market price that we have derived from the first point. Now, next method is income method. Friends, this method is scientifically the best method among all the three methods, the most logical method. It is advisable for each and every country that their national income should be calculated from income method only. But again, situation to situation varies, but income method is one of the best method among all the three methods. In this method, directly population's income is calculated. That is, factors payments are added. Now, factors payments are added. That is land, labor, capital, entrepreneur income. So in this first stage, we're going to find NDP at factor cost. Now, directly NDP, no GDP. Now, in NDP, we're going to get compensation of ME employees plus operating surplus plus mixed income of self-employed. It is nothing but it's a NDP at factor cost. Compensation to employees means salaries and wages. Means any income earned by employee from their bosses, bonus commission and any monetary and non-monetary benefits. Then mixed income should be added, and operating surplus means rent and royalty, interest income and profit. So when you add compensation to employee, mixed income and operating surplus, will be getting NDP at factor cost. Now, operating surplus you get from royalty, interest and profit. Profit you get from corporate tax, dividend and undistributed profit. Now, this is how you get NDP at factor cost. Now, after getting NDP at factor cost, now we have to calculate NNP at factor cost, that is national income. Then NDP at factor cost, just add NFIA, you'll be getting national income. So this was the income method. Now, in this formula, I've used one term called mixed income. What do you mean by mixed income? Guys, mixed income, that is income which cannot be separated from capital income and labor income. Means labor income and capital income is a mixture. Now, normally self-employed people and sole trader earn this income. When in a small business, owners and managers both are one and the same. So self-employed people like lawyers, engineers, traders, proprietors always enjoy mixed income. So this was the income method. After income method, next method is expenditure method. It is also called income disposable approach. Income disposable approach. From expenditure method. In this method, it is a demand side method actually. In this method, now final users expenditures are added. In this method, final users expenditures are added. So the expenditure method, national income is looking at total spending on final goods and services. How here we consider consumers government because they are the final users of goods and services. So the core logic behind this method is whatever is produced is ultimately purchased and whatever is purchased generates income. So total expenditure is actually total income, I can say. Okay, so the formula, first we're going to find GDP at market price. Now, it is a sum of all final expenditure of the society as a whole. Society as a whole means consumers as well as government. Now, GDP at market price, it's a consumption expenditure, gross investment and net exports. It's C plus I plus its net exports, X minus M. Right? This consumption expenditure and gross investment is actually done by consumers as well as government. Now, after finding GDP, we have to find national income. The formula is same: GDP minus net indirect tax minus depreciation plus NFIA. So you will be getting your national income, right? Note number one. Note number one, how to get GDP at market price. Consumption expenditure means it's a private financial consumption expenditure. PFCE means expenditure incurred on final goods and services by consumer. And GFCE, government financial consumption expenditure. Okay, sometime in the exam, that is defense expenditure, healthcare expenditure. Then investments, gross domestic capital formation. It's investment done by households also in jewelry, house property assets. Investment done by firms also in their fixed assets and inventories, and investment is done by government also. Now when I say the whole society, society comprises of household, firms and government, all the three. Net exports is exports minus imports. It is export minus import. So this is how now we will be deriving a national income from expenditure method. Hope you understood this consumption method also. So this was the methods of calculating national income. There were three methods, but out of all the three methods, the best method is actually a income method. So now the next topic is we should understand which transactions should not be included while calculating national income. Yes, following transactions never be included in calculating national income. Now, why these transactions are excluded? First, you should understand because they are not payments for the current production of goods and services. As you know, now in national income, only and only money value of that particular goods and services are added, which is which is produced in the current year, right? So these are the transactions now which might have not a payment for current production. So total 7 points are there which you have to remember. These transactions, if come in the exam, you always have to select which is not included. First is intermediate goods. Guys, their value is already actually included in the final goods. So if including again may cause double counting. So to avoid double counting, intermediate goods are always excluded. Second is non-monetary activities like household chores, now volunteer work, helping to a friends, painting for a pleasure. Now, why this is excluded? Because it has no market transaction, no price is involved. So here goods and services are produced, but it is free of cost, right? Now it has no monetary value, so it will not be get included. Then second-hand sales. Second-hand sales is like sale of used car, sale of used assets, and capital gains. Why? Because it is a past year's production and not a current output. So second-hand goods means these are produced somewhere in the last year. So when these are produced in the last year, why to include in the current year as it is already included in the last year's national income. Next is transfer payments. Now, fine. In this transfer payments, mere money is getting transferred and there is no exchange of goods and services. Like these payments are like as there were no goods and services exchange, pension, scholarship, unemployment benefits, donation, gifts, social security payments, etc. Now, why? Because income transfer without goods and services exchanges. It is like we are distributing money free of cost. Receiver is having income, but it's a free donation kind of. There is no exchange. Next is financial transaction. Buying and selling of bonds, shares, and debentures never get included in the national income because in this only ownership is changing and real production is not there. Just ownership is changing and real production is not there. Hence, it is not contributing to any kind of production. Sixth is windfall income and illegal incomes. Guys, lottery, gambling, smuggling, ठीक है? Now, these are never included even though now the winner is earning the income. Reason is it is a luck factor income. In reality, there is no production and economic growth cannot be considered on the basis of lucks. Okay, and illegal, which is not legal. How come you can consider in a decision making of economic growth? It is totally illogical. That's why both the transactions are excluded, hence not related to productive activity. Then various interest incomes. Oh, interest on borrowings, interest on government debts, interest on consumer loans. The above are not a payment for production of goods and services, right? So it is not a part of current production, hence it is not included. So these are the seven transactions which you have to keep in mind. It is never ever get included in the national income in all the three methods. Except this seven transaction, any other transaction now is always included in the national income. Okay, so by this, national income fundamentals are over. If you know these many points, you will be able to calculate national income. Okay, now let's understand some other small topics which has been directly indirectly derived from national income only. Okay, so there are three to four concepts which are interlinked. Understand, till now we have studied national income. Now from national income we will going to derive various transactions, understand the link up, and then we're going to get into one by one detail in every concept. National income is nothing but it's a NNP at factor cost. Now we're going to study till now after national income, we will going to understand now private sector income. After private sector income, we're going to get into the personal income. After personal income, from private sector income, we'll derive personal income, and from personal income, we're going to derive personal disposable income. Right? Okay. And then per capita income. So these are the concepts which we have to study. Okay, now these all will be get derived from each other concept. Let us understand. Now a simple differences are there. National income means it is an income of entire nation in which household plus private sector plus government sector is involved. When you add income of all the three, you get national income because country comprises of these three. Now I want private sector income, which is narrow concept than the national, and it has been derived from the national income only. So when I say private sector income, just remove the government, you'll be getting private sector income. Means only household income we need and business income we need. It can be private and public. Okay, here I'm writing business sector. Okay, fine. Then we need personal income. From private sector income is a broader as compared to personal. Personal income is narrow. Then from here, just remove business income. Only household income will be called personal income. We are household, you, me. If you want to try to calculate your own personal income, my individual income, it's a personal income. Okay, and then from personal income, you'll be getting personal disposable income. Now, what is it? That I'm going to explain you later. Let us understand for private, first private sector income and personal income. Now, private income. Private income is nothing but so private income is the income of household and businesses, right? Private sector businesses. So here to derive from national income, private income, some adjustments need to be done. So first you should consider national income, that is NDP at factor cost plus NFIA, and then you have to reduce some adjustments. Less remove government's income because in national income, government's income is there. So income earned but not received. Income earned but not received, that is income of government admin department you have to reduce, and savings of non-department enterprises also you have to reduce. Now, by reducing this, only private sector income and household income will be remaining, right? And then you have to add income received but not earned. It is that transaction which is never included in the national income. Just now we have studied. That is transfer incomes. Because it is not there in the national income, we have to add it. But sir, you told that this transaction should not be get included in the national income. Yes, but it should be get included in the private income because it's the income of the households, despite there is no exchange of goods and services. And interest on national debts. Point number seven. These two transactions should be get added. You'll be getting private income. Very simple, sir, funda. Very simple funda. Hope you understood. Yes. Now, here one technical word we have used, income of government admin department, that you have to reduce. What do you mean by income of government admin department? It means taxes, fees, charges, fines, penalties, etc. It's an income of the government. And saving of non-departmental enterprises. What do you mean by savings of non-government department enterprises? For that you have to refer note 2. It is a public sector undertaking and state-owned enterprises retained earnings. Means profit saved by a public sector undertakings and government departments. So this is what the private income. From private income, again we are narrow it down one more concept. It's a personal income. Now personal income means it's an income of only household. Now it refers to income actually received by household only. So personal income will start from private income. Now from private income we have to reduce retained earning because retained earning is a profit of the businesses. So remove businesses and corporate taxes. Once you remove this both, only household income will be pending, which is called personal income. Logic is very simple. Retained earning are not distributed and corporate tax do not go to households. So hence, two things you have to reduce from private income, you'll be getting personal income. Very simple. Now after that, next topic is personal disposable income. Personal income and personal disposable income is basically same. Just one thing is different, that is taxes. Yes. What does it means actually? Income available in the hands of individual for consumptions or savings. Now, and the formula is personal disposable income is equal to personal income minus personal income tax. Now, guys, in India, every person who is earning income have to pay some taxes. Am I correct? Now, so for example, my personal income, my personal income is 1 lakh. I've earned this month. But can I spend this for myself? No. From this, government is charging me income tax. In India, income tax is charged, that is 10%. So 10,000 I have to pay to the government. So how much is remaining for me for my spending and investments? It's 90,000. So 90,000 is called disposable income available to dispose. So after removing government payments to the from your income, the balance amount is your income. You can do whatever you want from that income. It's called disposable income. Okay. Next is per capita income. Now, per capita income means it is an income earned by a per person in the country during a year on average basis. So it is a measure of average income earned by per person in the country. Now how to calculate this? Friend, it's very simple. Now PCI is equal to total national income. I can say NNP at factor cost divided by total population. Because national income is what? National income is a total of sum of all the income earned by 140 crores population. Now I want how much one person have earned in the country on average basis. So just national income divided by total population. Now what it matters why we are calculating per capita income? Actually per capita income is an indicator of standard of living. It helps compare economic well-being from one person to another or from one country to another country. But one disadvantage, as it is an average income, it does not show the real picture. So it is not a perfect measure. But yes, now you can get an edge to understand some criteria. Okay, now after this last part, second last but very important, nominal GDP versus real GDP. It is also called nominal national income NNP versus real NNP. Now here the concept is not GDP or NNP. Here the concept is nominal and real. Here the concept is nominal and real. Guys, national income is calculated in two ways. One is nominal national income or nominal GDP, and one other one is a real national income or real GDP. What does it mean? Friends, when national income is calculated at current market price, it is called nominal GDP. When national income is calculated at current year price, now it is called nominal GDP. It is actually included, it includes actually inflation. Means national income changes due to change in price also. If price of product has become 100, your national income will be 100. If the same product's price increase to 150, your national income will also increase to 150, right? So here it includes inflation and deflation both. It is called national income is calculated current market price. So here national income, nominal GDP is calculated quantity produced into current price, right? Fine. And nominal GDP changes due to two factors. Due to change in increase in the production also, quantity of production, as well as increase in price changes. So there are two factors due to which nominal GDP keeps on changing. But you know what? It is not, it does not indicate real growth. Real growth comes when national income increases just by increasing the quantity production. If your income is increasing just by increasing the prices with inflation, that inflation nullify your growth. Your just monetary value is increasing, numbers are increasing. You will just feel the growth, but it's not a real growth. So nominal GDP fail to correctly explain the performance of the economy. Okay, now the opposite of nominal GDP is real GDP. Real GDP ignore inflation means in this national income is calculated at a constant price at a base year price. That year's price which is considered as a base for measuring. Okay, it is called real GDP because real GDP only changes by quantity produced. It changes only and only by increase in the volume of the production. It does not change it with the price. Price is assumed to remain constant, means it does not consider inflation and deflation. So it is a better measure to understand the performance of the economy. Okay, it indicates real growth. That's why the name is real. Now, real GDP is calculated as quantity produced at base year price and not at constant price. Now, it is also called GDP at current price. GDP at current price, and real GDP is also called GDP at constant price. So sometimes they're going to use term nominal and real. Sometimes they're going to use term uh, current price and constant price. Okay. So two types of national incomes can be calculated. Next is GDP deflator. Next is GDP deflator. What is GDP deflator? Guys, it is a one of the formula, one of the index to calculate inflation or deflation between 2 years GDP. It does not calculate current year's inflation and deflation, okay? Between 2 years GDP. That is the base year's GDP past year with which you want to compare with current year's growth. So GDP deflator formula is nominal GDP upon real GDP into 100. And this is the real actual formula. Rest is reshuffling. Sometime in the exam, they're going to tell you to calculate real GDP and they're going to give you nominal GDP. So nominal GDP into 100 upon price index you're going to consider, and nominal GDP, real GDP into price index upon 100. Now what does it indicate? Friends, when you're going to calculate GDP deflator, you will going to get GDP deflator in a percentage form. Yes, because you're multiplying with 100. So GDP deflator is calculated in a percentage form. If you get a percentage less than 100%, that is 90%, 80%, 95%, it means price has fallen, means deflation is created. But if GDP deflator indicates 105%, 110%, 120%, that means price have risen as compared to the past year. Inflation have taken place. Okay, so guys, these were the all other outside important concepts which I've completed. By this, your national income chapter is actually over. But final mantra of this chapter is national income accounting is not about memorizing formula, guys. It is about understanding how production income and spending is connected. Hope you got it. So that's it, my dear students. This was your quick revision session. Simple words, clear concept. Now there is no room for confusion. If you understood everything in one go, say yes, sir, and give it one more quick revision. Remember, smart study is the best strategy. Keep revising, stay confident, and believe in your preparation. And don't forget to tell your friends that these notes are total exam lifesaver. Stay consistent, stay motivated, and I will see you in the next rapid fire revision.